So just quickly want to run because we've got people that join us at a later stage, which we have just to run for respect as well amongst us. For respect as well amongst us to be able to understand these rules. For everyone who comes in, please note you are required to switch off your video. Please mute your microphone. Write your student number in the chat. Please have your financial calculators ready because we are going to use them when we are working on revenue. If you've got any issues, any queries relating to previous recordings of today, please send your queries to ctntat@unisa.ac.za. You are also requested to also complete a feedback form, which you can be able to find on your files. So it is understandable as people come in, we'll keep hearing that noise, but specifically, my request is for us to try and work specifically with our microphones, that we try to mute them. So that's basically it on the introduction. So we move immediately to working on financial instruments. So I'm just opening the slide. On financial instruments, we'll see how far we can get. And we'll see how many topics we can be able to do. Right, there is the presentation. It is also found on my UNISA on additional resources. On additional resources on my UNISA, you can also find these presentations. Very nice presentation. I strongly recommend for each learning unit that you go through each presentation. And because accounting is all about understanding the theory. And if you note, when we're dealing specifically with leases, financial instruments, revenue, and almost investment property, you cannot pass accounting by fluke on those 4 standards. I'm still touching on PPE, I'm still touching on inventory, but the most ones that require most theory are your latter ones with lots of theory. Your inventory has got theory, but very limited as compared to other units. So it's very important that you do get yourself time to go through the theory, work through the examples, and then attempt to do exercises as you go along. So the presentation, as I said, it's about financial instruments. Financial instruments are covering basically 3 accounting standards: your IFRS 7, IFRS 9, and IAS 32. So these 3 standards, IAS 32 mostly contains the definitions of financial instruments. So it addresses issues such as classification of financial instruments, what is a financial asset, what is a financial liability, what is equity, and the classification of the related interest, dividends, gains, and losses as well. IFRS 7 deals only with the disclosure of financial instrument. IFRS 9 deals with classification, measurement, and impairment methodology of financial instruments. So it is therefore important that when we are going through the study unit, we also try and mirror what we have in our study guide and what we have in our prescribed textbook. Because remember, a study guide is just a guide to get you there, but mostly the crux of the information, you get it mostly on your textbook. So the guide is just to guide you, and I want you to keep that and the textbook is meant for you to be able to learn definitions and to be able to practice examples that you find, including getting to complex examples. So in terms of your syllabus, you are also told bond debentures, cum dividends, ex-dividends, foreign exchange contracts do not form part of this module and therefore can be ignored. Then you are also told that the effective interest rate is always calculated as if compounded annually. Therefore, no tricking you. Effective interest rate is the one which caters the compounding periods during a payment plan. Then we get the definition. The nominal interest rate is the periodic interest rate times the number of periods per year. So you are also told that nominal interest rate does not take into account the compounding period. It's only the effective interest that takes the compounding period. Then in terms of recognition and measurement of financial instruments, one important thing, financial instruments are initially measured at fair value, and they are also subsequently measured at fair value. So we are going to deal with different elements of financial instruments, but we will get there just now. Amortized cost is also not part of this module. Transaction cost is just a reference of an example that you can work to. Yes. So in terms of the classification of financial instruments, we get what we call financial assets and financial liabilities. So by definition, a financial asset is cash or any equity of another entity. For example, if you purchase shares in another entity, and then in your financial statement, you see something that says investment of A Limited, for example, that investment would be your equity instrument of another entity because you have a subsidiary. So it's also a subsidiary, it's also an interest that you have purchased of another entity. The main thing that is important is it is also a contractual right to receive cash or another financial asset of another entity. So the definitions, you can be able to zoom in into your study guide, and you find them on page 158 and 159, which covers the methodology. And for each, you are then given a reference of an example that we can work on. We will be able to work on examples at a later stage. This is just to give you a glimpse of the definition. So financial asset is cash, an equity instrument of another entity, a contractual right to receive cash or another financial asset from another entity, to exchange financial asset or financial liabilities with another entity. So basically, your examples of financial assets would be your receivables, would be your bank account, which is your cash, would be investment. And when we're speaking about investment, we will also speak about this because we are touching on two things. When we're saying investment, we're touching on the current investment, and we're also touching on the non-current investment. So you are told that in terms of the measurement, financial asset is measured at fair value. If it is financial asset that is measured at fair value, it will also be measured in terms of fair value through profit or loss. Or it will be financial asset that will be measured through other comprehensive income. So for the one that is measured through profit or loss, it means that it is held for trading. That would mean that it is held for trading. And then when we're speaking about the differences that you get when you are measuring it through profit or loss, the differences becomes gain and losses, or income or expense in your statement of profit or loss, and other comprehensive income. And your investment would always be held at fair value, and at financial asset through profit, through fair value, through other comprehensive income. There we are speaking about we're speaking about cases where your financial assets are measured in terms of fair value, and they also include transaction costs. We'll also touch on transaction costs, the fair values and gains differences. In terms of the fair value adjustment, is accumulates to market reserve in equity, and then your investment would be non-current asset. So for financial asset measured at fair value through profit or loss, it will be current assets. For financial assets at fair value through other comprehensive income, in the statement of financial position, it will be non-current assets. So we've got an example here. So this example is already covering the journals below, but what I can just do it is just to explain through the journals. So this is an example for fair value, financial asset at fair value through profit or loss. So in this particular instance, we are told that A Limited bought 1,000 ordinary shares in B Ltd at 5 Rand per share. On 1 January 2017, transaction costs amounted to 500. At year end, 28 February, the shares traded at 7 Rand per share. So to be able to deal with the requirement here would be, please prepare the journal entries. So I just want for us to be able to do this part as well, despite having a solution in front of us, but at least to give you a heads up of what we are working on. So working on learning unit 8, financial instruments. So we're dealing with this example, example 1. So I'm gonna just try to break it down in this example, what is going on, to be able to translate this into a bit of theory in your hands. A Ltd bought 1,000 ordinary shares in B Ltd at 5 Rand per share on 1 January 2017. So I just want us to speak about this first transaction. What happens here? So what happened here is A Ltd becomes a parent in B Ltd. So having bought 1,000 ordinary shares, it means we are now holding an equity of another entity. So in terms of the financial asset definition, we are holding an equity instrument of another entity. So in this case, A Limited holds shares, and this is an equity instrument. Shares is the equity instrument. Shares, A holds shares of B Limited. And here we're speaking about 1,000 shares. and you are given the value at which these shares were bought at 5 Rand per share on 1 January 2017. Transaction cost amounted to 500. At year end 28 February 20, the shares were trading. So you are told here that the shares are held for trading or speculative or short-term nature. So shares that are not held. So this also LTD here is telling you that we are working here with a public company. We're working here with a public company. So if A Ltd bought 1,000 shares, this means that these shares are held for trading. So in any other questions, you would be informed about this particular part, if shares are held for trading or not. But in this one, we assume that these shares are held for trading. If they are not held for trading, you'll be told that they are held for speculative nature, or you'll be told that it's for short-term nature. So this means doing our journals on 1 Jan 2007, 2017. So here we would have the debit and we would have the credit. So here, the first thing that we would recognize in our books, it's a financial asset. A financial asset which is going to be 1,000 shares multiplied by 5 Rand. And then here we've got 1,000 multiplied by 5 Rand. And then we check how was these shares bought. We are not told anything how they were bought, but we also see that we've got transaction costs of 500, and then that means that we'll also have bank of 5,500. And this is recognition of financial asset at fair value through profit or loss. So this would be your journal entry that you would have. Now, on the same year, which is our year end on 28 February, now the following year, we are told that the shares were trading at 7 Rand. So this means that our financial asset is now growing at 2,000, and this 2,000 is made up of 7 Rand minus 5 Rand, and then multiply by 1,000 shares, which gives you 2,000. And then you also have a gain on fair value gain on fair value adjustment on financial asset of 2,000. And this is at year end 28 February 2018. Now let us explain this quickly. So the financial asset here is what you would have in your statement of financial position. Transaction cost is what would go in your statement of profit or loss, statement of profit or loss, and other comprehensive income. And your bank would be from statement of financial position. And this financial asset is sitting in statement of financial position. And this gain is also sitting on statement of PL and OCI. So this is just PL. So this means when you are doing your actual financial statements, this amount of 500 would be other expenses, part of other expenses, and this gain on fair value would be part of other income. And in your statement of financial position, so this will be your statement of profit or loss and other comprehensive income. So this is other income after your gross profit. Then in your statement of financial position, you would have under current assets, you would have what you call investments. Investments, or this becomes a financial asset, and the amount that you have here is 7,000, which is the amount that you had at the year end. So this amount is made up of the actual 7 rand multiplied by 1,000 shares. So this is what happens. So what I want you to understand in this example is A, which is the company that you are making the financial statements for, has bought 1,000 ordinary shares, which means that it's an equity of another entity. An equity of another entity. Please, those who keep coming in, please do not forget to put in your student numbers. I apologize. I just have to keep looking in my chat history to make sure that there is no one that I am leaving behind. I'm working on the example Tsepiso that is on this presentation. So it's an example that is on this presentation, and I'm just trying to unpack the first part, which is financial assets through profit or loss. So the second part, we're honestly not going to exhaust it much, but it's just not different from what we've covered. So it's just another example. So example 2 is the same scenario, but in example 2, you are told that the shares are not held for sale. So for this example, the shares are not held for trading. So there it is there at the top. The shares are not held for trading. For this, so for the first example that we covered, the shares were held for trading. The second one, we are told that the shares are not held for trading. Right. So in the first one and the second one, the difference is the issue of trading. So the first one we have dealt with. The second one, financial asset at fair value through other comprehensive income. So that is the measurement. That is the classification that you are using for a financial asset. So both these are financial assets, but in terms of the classification. So two things that I really want you to understand is on financial instruments, I want to do this here because I know that you can be able to access this thing at a later stage. So we've got definitions, which defines your financial asset, financial liability, financial instruments. So which tells you that when we're talking of financial instrument, we're talking of any contract that gives rise to a financial asset of one entity and financial liability or equity instrument of another entity. That is the definition of your financial instrument. But now, after you've covered definition, we speak about classification. Now, in classification, this is where now we're saying you've got a financial asset. And how is this financial asset measured? So your financial asset is measured at fair value. Then it's measured at fair value through profit or loss, or at fair value through other comprehensive income. So OCI means other comprehensive income. And then when we're saying PL, we mean profit or loss. So for someone who does not understand these abbreviations, PL means profit or loss. OCI means other comprehensive income. So which means when you are buying a financial asset, and remember by definition, we said a financial asset, it's cash or an equity instrument of another entity. So when you are buying a financial asset, you are buying it at a fair value. So we have dealt with the fair value definition, where we have said fair value of an instrument would be the price amount at which the asset or liability could be bought or sold in a current transaction between willing parties or transferred to an equivalent party. So that is the definition that you can be able to get on page 163 of your study guide of fair value. So when you are dealing with financial instruments, you also incur something called transaction cost. So your transaction cost can be legal cost in order to be able to register your shares that you are buying, any legal or transaction cost that you have to incur. That's one of the things that we are speaking about as well. So in this particular case, transaction costs are incremental costs that are directly attributable to the acquisition, issue, or disposal of a financial asset or financial liability. So it's one of the costs that you incur at acquisition of a financial asset or financial liability. Now, in terms of the classification, an entity shall classify financial assets and subsequently measured at amortized cost or fair value. So in terms of amortized cost, you guys, it's not part of your syllabus. So we're dealing with the two, which is for the purpose of this module on page 164 at the top. The only following financial asset categories will be dealt with: fair value through profit or loss, fair value through other comprehensive income. So which means that we are dealing with a financial asset measured at fair value through profit or loss, or fair value through OCI. So financial asset will be classified if it is measured at fair value through profit or loss, if the asset is held for trading or speculative or short term, or you are told that you are intending to sell it in future. So those are the requirements for financial asset through profit or loss. Financial asset through other comprehensive income. You'll be specifically told it's not to be held for trading. It's for long-term investment. That is OCI. So in example one, we're dealing with financial asset that can be held through trading. In example two, we are dealing with one that cannot be held for trading. So in example two of this presentation, It's the same scenario that we are given as per number 1. Here, it's the same thing. We are going to be, in terms of our journals, we're going to be recognizing an asset on the debit side, financial asset, statement of financial position. And then we are told that we have transaction costs. You also have transaction cost of 500 rands, and you also have a bank. So at the bank, you're still paying 5,500. But now let us discuss now the differences with number 1 and number 2. The financial asset held through other comprehensive income. So your journal entry will be to recognize the financial asset held through other comprehensive income is that the financial asset here includes transaction costs. So you capitalize the transaction cost in the financial asset. So it will be times 5 rand and then plus 500 rand of transaction cost, which gives you 5,500. So to repeat again, on your financial asset that is held through other comprehensive income, the financial asset held through other comprehensive income, you have to capitalize the transaction cost. In other words, your transaction costs form part of your financial asset. You capitalize them there, and then your credit becomes bank. And then on the 28th, so this will be on your 1st, and then on your 28th of February 2018, you also in this case have a financial asset that increases, and then you also have a gain. A gain on financial asset, this gain goes to OCI. We'll speak about it now. The one on top goes to the part of profit or loss. We'll talk about that shortly. So in this case, the calculation that you are going to get to here, to get to your answer, is going to be 7 rands multiplied by 1,000. 1,000 shares minus 5,500, which is going to give you 1,500. 1,500. So here you're recording recording fair value on fair value adjustment at year end. So in terms of your statement of profit or loss and other comprehensive income, this amount goes to OCI, which is other comprehensive amount. The rest goes into your statement of financial position. It goes under non-current assets. And you've got investment in B Limited. And then it will be at an amount which is at year end of 7,000. So if you can just hold like that just for a minute, just want to check something. And this OCI will go to your statement of changes in equity, and there it will fall under something called mark-to-market reserve. And the mark-to-market reserve will be 1,500. So to explain this again, this gain on financial asset, where your financial asset is measured at fair value through other comprehensive income, it goes to other comprehensive part in terms of your statement of profit or loss and other comprehensive income. And then in your statement of changes in equity, it goes under an equity reserve called mark-to-market reserve of 1,500. And on your statement of financial position, your investment goes under non-current asset because it's not held for trading. It's meant to be for long-term investment. So in terms of financial liabilities, we are now on page 165. Financial liabilities will be measured through profit or loss. In terms of financial liabilities, one thing that is stressed is to please learn the disclosure of long-term loans in terms of financial liabilities. This is the part that you are told to learn in terms of this syllabus, but in any case, financial liability is classified as held for trading if it is acquired in CAD principal for the purpose of selling or purchasing. So there we are speaking about mainly long-term loans, which will be covered in terms of your syllabus. So these long-term loans, you can have a portion. Sorry, a portion here that goes for, you'll have a portion in terms of disclosure of, you'll have a short-term portion of a long-term loan, and this goes to current liabilities. And then you will have a long-term, I wanted to say short-term, and then you will have a long-term portion of long-term loan, which goes under non-current liabilities. So on financial liabilities, that is what you need to cover. It is the disclosure part of financial liabilities. So you are given examples on page 165. You are given examples in your study guide, and page 166 also gives you nice examples, and 167, 168 repeats everything that we have just covered. In terms of your study guide, 169, it speaks about the recognition of a financial asset. So the recognition means it's a removal of a previously recognized financial asset. You only derecognize when contractual right to cash flow from the financial asset expire, financial asset is transferred, or transfer qualifies for derecognition. So you are told that financial asset recognized as fair value through other comprehensive income must first be stated at fair value before recognition. This will result in no additional profit or loss on derecognition. The entity may reclassify a resultant balance in the market reserve directly to retained earnings. So to simplify that part of page 169, derecognition simple says this: if you are selling, if you are holding shares for trading, financial asset for trading purposes, when you recognize it, it must only be when you are selling the whole investment. So when you sell the investment, it means that you will have a profit on sale of an investment. If it's through other comprehensive income, fair value through other comprehensive income, any balance that was sitting on mark-to-market reserve must be directly transferred to mark-to-market, to retained earnings. So if you no longer have financial asset measured through fair value through other comprehensive income, you are recognizing it. Therefore, whatever balance you had in your mark-to-market reserve, you have to transfer it to retained earnings. So on financial liability, you only recognize financial liability if you have, of course, settled. Here we're speaking about if you have settled a loan or whatever it is that you have settled. So that almost covers everything. And the next thing that they talk about, it's a disclosure. So in terms of the disclosure, I want us to look at example 5. And this example 5 is found in your study guide in terms of presentation to financial statements. I love that example very much. Example 5, I'm just looking for a page quickly. It's a comprehensive example, example 5, that I think we can be able to cover in the next 10 minutes. So it's on page 43. Page 43 of the study guide. Let me also open it. Example 5, page 43 of your study guide. So we've got a comprehensive example. You are told that the following was taken from the books of Rainbow Limited for the year ended 28 February 19.4. You've got preference shares. So remember when I said financial instrument, I never said what kind of shares we are looking for. So if we are not mentioning any shares, that means that we are also covering preference shares as well. So preference shares, they can be a financial asset, or it can be a financial instrument, or it can be an equity. So it's something that you can be able to study well on the financial instruments part. So I'm not going to put much emphasis there. We're going to come back to the summary of financial instruments, but just want to talk about financial instruments. So we see ordinary shares, we see preference shares, we see proceeds of 50,000 new shares issued, share issues incurred on the above share. We see debenture issue expenses, debentures. We see bank overdraft, we see trade and other payables, land, long-term loan, financial liability. And then we have additional information. And then the requirement is to prepare statement of financial position, statement of profit or loss, and also statement of changes in equity. And definitely one other part that they are touching is also relevant notes. So let us look on the additional information for financial instruments. You are told that the following must still be taken into account. So this is a capitalization. So this is a statement of changes in equity part. This is a statement of changes in equity. To write off all share issue expenses, preliminary and debenture issue. This is PPE part. Surety. So you are told that number 4, investment consists of the following. 4.1, Opequin Limited, subsidiary of Rainbow Limited. So already, this is a financial asset, which means it's an equity of another entity. So you are told here 10,000 ordinary shares of 30,000. So a investment in subsidiary, it's a non-current asset. So I just want to quickly edit things as we are talking through, because we're not going to get to a solution. So a subsidiary becomes a non-current asset. So on non-current asset, you are going to say investment in subsidiary of 30,000. So this will always be at cost because it's an equity instrument. It will always be at cost, which also is the fair value. So 4.2, blue listed on Johannesburg Securities Exchange, bought for speculative purposes. So they tell you here it's for speculative purposes. What does this mean? This means that this investment will be on current assets in terms of the disclosure. Secondly, whatever difference that you are going to get here. So for example, the difference that we are going to get here in terms of us calculating the part of other income. When we are calculating the part for other income, so what we are going to get here is we are going to say, because shares were 50 Rand by end, we say 50 Rand multiplied by 1,000 shares minus 40,000, which is going to give us a difference of 10,000. And this difference becomes gain in financial asset, and this goes to profit or loss. So this goes to profit or loss. This part goes to profit or loss. Why? Because it's for speculative purposes. So which means that the financial instruments are held through profit or loss. 4.3, CRIM Pty Ltd is an unlisted company designated as not held for trading. So this tells you that it is held through other comprehensive income. This one means it is held through fair value, through profit or loss. This one would be fair value through OCI. So you are told that 200 ordinary shares were held for how much? 16,000. And then you are told director's valuation on 28 February amounts to 20,000. So which means in the previous year, the fair value of all investment above was equal to their cost prices. So this simply means that at year end, we are going to have gain on financial asset, which is going to be on other comprehensive income, which is going to be 20,000 minus 16,000, which is going to be 4,000. You're going to include it as part of your gain on financial asset at fair value through other comprehensive income, which is 4,000. This 4,000 on a statement of changes in equity. So if you are doing statement of changes in equity, it becomes an addition to market reserve. That's where you are going to add it. So we also have another financial liability, an unsecured loan originated on one on 1 March 19.3 is repayable in annual installment of 10,000 on 1 March every year. Interest for the current year at the current rate of 10% must still be provided for and is payable on 5 March 19.4. RENPO uses the settlement basis of accounting to account for its financial instruments. So let us go look what is the year end that we have. So our year end is 28 February 19.4. We are told 19.4. So this loan originated in the previous year. Is it the previous year or is it beginning of the year? It originated beginning of the year, sorry. Originated beginning of the year. And every March, we have to pay 10,000 and we are told how much is the interest. So I just want us to do a disclosure for this one. So we are working on example 5, which is in terms of presentation of financial statement. International Accounting Standard 1. So what I want us to do there is to do a disclosure of long-term liabilities. So that's what I want us to do there, because we are told that this is an unsecured long-term loan. So the first thing that we are going to be doing here is we are doing a disclosure. So we give it a number. This is a long-term loan. So we have a long-term loan. A long-term loan is made up of two things. So we have a total long-term loan given of how much from the balances, long-term loan of People's Bank. We have it there. As 50,000. So we have a long-term loan of 50,000, and we are told that this loan is payable every March. So which means that the current portion of long-term loan is 10,000, which is what we are going to be paying the following year. So in essence, this means that our long-term loan at year end is therefore going to be 40,000, which is made up of 50,000, which is long-term loan, and is made up of 10,000, which is the current portion of the long-term loan. And then the most important thing is to do say the long-term loan is unsecured. We have been told it carries interest of 10% per annum and 10,000 rands is payable on March every year. So what we know is this long term was taken in the current year, and if we are paying 10,000, it means that we are paying 10,000 per year. Every March we pay 10,000 every March, and then the first March of the following year we're going to pay 10,000, and then the 40,000 becomes the long-term part, which is also known as the long-term non-current portion of long-term loan. So please get this disclosure note correctly. This is where I've taken it so that I can be able to make you this very good example about the financial liabilities that you are supposed to study. So the rest of other things that are important in terms of financial instruments, we're back again at financial instruments. We are just going to be looking at the summary part of financial instruments, and then therefore afterwards we move on and we go and we do leases. Sorry, we do revenue. So let us look at page 172. You are given an issue about preference shares. So preference shares depend on whether they are redeemable or not redeemable, but you have been given a nice classification and examples there, which I believe that you will be able to study. But on page 171, one important thing is to consider the lecturer's comment that says only classification of preference shares, that the disclosure of preference shares is important for this module. So the accounting of redeemable preference shares on redemption date and conversion of preference shares to ordinary shares do not form part of this module. So you are only working on preference shares, only the classification and the disclosure. So you are given the classification and you are given the disclosure as well. The interest and the dividends, you are given the definitions. Here is the disclosure. So this is just a disclosure for everything that we have covered, where if you're dealing with profit or loss on the profit before tax note, if under income or expenses, you make the fair value adjustment, investment under current asset, and then for other comprehensive income, you are given where and what will be disclosed where. This is a summary of everything that we have covered. Amortized cost, not applicable. That's why I did not even touch on it. You are given examples of disclosure notes. And with that, we are finally covered on revenue. On financial instruments. So quickly, what I want to look at now in terms of the chart before we move on to the next topic, I just want to check if you have any questions. I was not able to go through I'm extremely sorry. I am honestly not sure why our sound is like this today. I'm honestly not sure, but I hope you guys were able to cover everything that I have shared. So I just want to check in terms of everything that we have spoken about before moving on to revenue. I just want to check if you've got any questions that you may have relating to financial instruments specifically. Examples that we have covered, I have tried to cover this example 5, the disclosure of long-term loans. I've tried to cover, to explain for you where and what will be covered where. So I just want to check if there is anything else that you may have a question on financial instruments. Right, I'm giving you guys another chance. Everything that we have covered on financial instruments, I am just requesting if you've got any questions that you may have relating to what we have covered today on financial instruments. So to make a summary, we have spoken about definitions of what a financial instrument is. So I tried to walk through your study guide. Your financial instrument being any contract that gives rise to financial asset of one entity and a financial liability or equity instrument of another entity. We covered the definitions of financial asset. There's nice examples that you can find in the study guide. Examples of financial asset and financial liabilities. We've spoke about the measurement that financial assets are measured at fair value. So they are measured at fair value. And then the classification is fair value through profit or loss, or fair value through other comprehensive income. We have covered that in terms of the fair value through profit or loss. It is when an entity purchases financial asset mainly for speculative, short-term, or held for trading. In such instances, you recognize an investment. Subsequent measurement, if the fair value changes, will always be recognized in your profit or loss on other income or other expenses as fair value adjustment of a financial asset. And then immediately, you will also recognize that portion when you are doing profit before tax. So example 5 on IAS 1 summarizes very nice your financial instrument. Only look for the financial instrument part, then you will be able to follow exactly what we are covering. And then on financial assets held at fair value through other comprehensive income, we said whatever differences that you get in subsequent measurement, you on the other comprehensive part of your statement of profit or loss and other comprehensive income, on the other comprehensive income, you add gain of financial asset through measured at fair value through other comprehensive income, and then you take that amount to your statement of changes in equity to mark to market reserve, and then that's it. Then in terms of your financial liabilities, I will post the solution that I was working on in terms of example 5. You will do the disclosure for long-term loans. So that's what is important, that at least you must know. So we are going to move on now. Remember, if you have any questions, you're still welcome to post them even after the class. I will still get back to you. So I hope the sound has improved, and I honestly apologize for my sound today. It is honestly not my intentions that you guys struggle to hear me. So we are moving on to revenue. Revenue again. Here on the revenue, we are speaking about what is the most accounting standard that we are going to apply in recognition of revenue. So the accounting standard that we have is called IFRS 15. It's quite a new accounting standard. That's why if you look at old exam questions, you will not get it much. So the first time that I think it was tested was possibly year-end October, November 2016. So we are going to cover a bit of theory in terms of the presentation, and then we are going to try and do about 3 questions coming from there. Mostly revenue from accounting standards. Let's look at the presentation that we have quickly. I will, every 5 minutes, try to come back and look at the chart so that I'm able to see if my sound is still giving you guys any troubles, but I am glad that it's getting better now. So let us look at revenue. On revenue, I'm also going to look at a presentation that is also found on additional resources. Additional resources in terms of your in terms of your my UNISA. When you get to my UNISA, you'll find this presentation there for each module. So let us cover IFRS 15. So the core principle of IFRS 15 is how the entity should recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. So here we're speaking about revenue from contracts with customers. So three keywords are: it's recognizing revenue, it's transferring promised goods or services to customers in exchange for a consideration once we have given the goods and services. So we are working on this presentation, and we are also working on your sorry, I just want to, yes, my volume is right this side. So I was just investigating one of these things happening with the mic. So on page 179 of your study guide, you've got definitions that we are going to deal with. Definitions such as a contract asset, contract liability, a customer income performance obligation, revenue, standalone price, transaction price. So these definitions on page 179, you should study them. So every time we go through examples, you are doing a question, you can keep coming back to them so that you are able to apply them. So one important thing about IFRS 15 is that for an entity to recognize revenue, it must apply 5 steps for revenue recognition. 5 steps for revenue recognition. Step number 1 is to identify a contract with a customer. Step 1 is to identify a contract with a customer. Right, I just wanted to look at the issue of sound. Everyone is still fine. So step 1 is to identify a contract with a customer. So how do we go about identifying a contract with a customer? So on page 180, you are given another 5 inputs into identifying a contract. 1, you are told that for parties to the contract must be approved. A contract can be in writing, it can be oral, or in accordance with other customary practices. So here we are speaking about identifying a contract. There must be a contract approved. It must either be in writing, orally, or in accordance with customary business practice. 2, the entity can identify each party's rights regarding the goods or services to be transferred. So when we say identify each other's rights, we're saying a customer and a supplier, which is a company in this part, what are our rights between the two of us in terms of the goods and services? 3, we must be able to identify payment terms. How is the customer intending to make payment, and what is payment arrangements? 4, the contract must have a commercial substance. So the risk, timing, and amount of the entity's future cash flow is expected to change because of the contract. So it must have a commercial substance. Then it must be probable as well that the entity will collect a consideration. So you're also told that it is important to note that the contract does not exist if each party has got unilateral enforceable right to terminate the contract without compensation. So the IFRS 15 does not apply. and then you are given further examples. Two issues that may complicate the identification of contract is existence of a combination of contracts, modification of contracts. So 9.2.2.1, you are told what is a combination of contracts. When two or more contracts are entered into with the same customer, you must determine whether the contracts are to be accounted for as a single or as a separate contract. So it's either contracts are negotiated as a package with single commercial objective, or paid under one contract is dependent on the price or performance of another contract. Goods and services promised under our contract constitutes a single performance obligation. So that's what gives rise to either a combination of contracts or contract modification. So contract modification, a contract may be modified after its inception. So inception means after the contract has been approved and is a legal document. So modification is a change in scope, price of contract that is approved by parties to a contract. So that is what covers step one. So the important thing on step one is it's also 5 inputs that you need to know about identifying a contract with a customer. So a question can come and say, please, in terms of multiple choice or in terms of a discussion question, where you are told that in terms of step one, or they just say, looking at the above information, would you be able to identify a contract with customer so and so, and they say for 5 marks. So it means that you must be able to look at what is it, what are the 5 inputs that you are looking at. Step number 2 is to identify the performance obligation in the contract. Now, what is a performance obligation? A performance obligation, in terms of the definition, it is a promise in a contract with a customer to transfer one of the following: a good or a service, or a bundle of goods or services that is distinct, or a series of distinct goods and services that are substantially the same, that have the same pattern of transfer to the customer. So I'm not sure if you're still with me. Step 2 is to identify separate performance obligation in the contract. So one, a customer can benefit from the good or service either on its own or together with other resources that are readily available to the customer. So there's an example that we will cover this on, that I will do with you. 2, the entity's promise to transfer goods or service to the customer is separately identifiable from other promises in the contract. That is, the goods are distinct within the context of the contract. So we will do examples that cover this. Non-distinct goods and services that is not distinct should be combined with other goods and services in the bundle. A series of distinct goods and services are substantially the same, have the same pattern of transfer. Step 3, in step 3, we are saying you determine the transaction price. So the transaction price can, one, can be a variable consideration, an expected value, most likely amount, or there can be an existence of material financing component in the contract, where you have got to consider time value of money. So you adjust the promised amount of consideration to the effect of time value of money. Non-consideration, where you consider fair value, IFRS 13, which deals on fair value. Consideration payable to customer, Number 4, it's allocating transaction price to the performance obligation. We are going to work through it. Step 5, it's recognizing revenue. That is, when is the entity going to satisfy a performance obligation? When are risk and rewards going to be transferred from an organization to another party? So you've got construction cost as well, contract cost. You are given examples to work through. So let us look at what we have here. This repeats everything that I have covered. Repeats things that I have covered. Allocating, recognizing when the entity satisfies a performance obligation. So you are told that an asset is transferred when a customer obtains control of that asset. Each performance obligation is satisfied either over time, and then you'll have to measure revenue over time in terms of outputs versus input, or it is at a point in time. A point in time means one, a customer has a present obligation to pay, accepted the asset, risk and rewards of ownership transferred, physical, customer has a physical possession of the asset, legal title of the asset. Revenue from contract with customers, contract cost. An entity can incur costs in order to obtain a contract. So costs to obtain a contract, they are capitalized as an asset. Marketing, legal costs, and this means that these costs can be recoverable. Costs to fulfill a contract are directly related to a contract. They are also capitalized. You are told about amortization. Presentation. The following are revenue-related items: trade receivables, contract assets, contract liabilities. Presentation important to understand the nature, amount, and timing and uncertainty of revenue and cash flows, contract with customers, significant judgments. So let us do this example. Let us quickly do this example. We'll also do a similar question that was in question 2 in October, November 2016 exams. This question says on 1 March 2018. Actually, I think I would rather want us to do these 2 questions in terms of these examples provided for here. So example 1, revenue, time value of money. Lipton Ltd, a tea coffee manufacturer, sells a coffee machine for 150,000 to a customer on credit, on the condition that the amount must be paid for on the 28th February 2020. So I want us to read with understanding. So let us read again this question. It is also posted on my UNISA additional resources. Same question exactly as per the presentation of revenue. But I want us to understand this question very clearly. On 1 March 2018, Lipton Ltd, a tea coffee manufacturer, sells a coffee machine. So that's what we sold, a coffee machine to a customer on credit on the condition that the amount must be paid for on the 28th February 2020. The financing component is significant. Lipton Ltd's incremental borrowing rate is 9%, and the customer's credit risk is 15%. So I want us to unpack this example. Example 1, we'll look now at the requirement. We are required to prepare journal entries for the above transaction in the books of Lipton for the years 2018, 2019, and 2020. But before we do all that, I want us to first apply the 5-step model for revenue recognition. So step 1 says you must identify a contract. So let us look, can you be able to identify a contract in this case? So what are the things that we look at in identifying a contract? Is 1, the contract must be approved. So here we are told that this was sold on credit. So the credit part indicates that there is an approved contract. I'm just helping you in case you once deal with a discussion question. Can you be able to identify each party's rights? Yes. Lipton is a manufacturer of coffee machine, and the customer is the one who is buying. So the rights of seller and buyer identifiable. Number C, what are the payment terms? So in terms of the payment terms, it's on credit and it's payable on 28th February 2020. The transaction has got a commercial substance, yes. We are told that the financing component is significant, which means value for money. Will be applied. So this talks about the commercial substance. And the last one is, it is probable that a consideration will be collected from a customer because the credit amount customer for fee machine. So this is step 1 that we have done here. And then we look at step 2. Step 2, people always say it's the most difficult step because it's now new terminology. Identifying performance obligation. So identifying a performance obligation here, we are looking at a promise. What is promised goods and services? So a performance obligation here that is promised, it's a coffee machine. Nothing else other than a coffee machine is promised. So this is for a good or a service that is distinct. So honestly, nothing difficult about this. So and we can see that the performance obligation is it's buying the machine. So it's a promise to deliver a coffee for a consideration of 150,000. So that's what we see. So which means that the coffee machine is distinct because we are only comparing it. And what we mean by distinct is that the customer can benefit on coffee machine on its own. So the ingredients and everything, they would have to get it themselves. Step 3 is determining the transaction price. Transaction price. So this is where the issue is. We need now to identify the transaction price for the contract. So it is the amount of consideration that the entity expects to be entitled to in exchange for selling the coffee machine. So in this particular case, one thing that we are noting is an existence of a financing component in the contract. This is a statement that you've just been told, which means that we have to apply time value of money principles. This was step 3. Step 4 is allocating transaction price to the performance obligation. This will be simple. Amounts that we get on step 3, we apply them to step 2, which means that whatever amount we get, it's a performance obligation. So that is the amount that it will take to deliver the coffee machine. And then our step 5 is quite simple. Step 5 will be recognition of revenue. So the question is, when will, what is the name of the entity? Lifting Ltd satisfy performance obligation. So it will be on 28 February 20.18 when the customer is paid for the coffee machine. That's how simple it is. It will be on the 28th. Sorry, let's look at the question again. The question we have to make now, the question now becomes, when do we recognize revenue? At a point in time, over time, or when the customer obtains control of the asset. So in this case, on 1 March 20.18, coffee machine is delivered to the customer. So on 1 March, the customer can use the coffee machine to produce goods or services to make anything out of goods and services, the customer can control asset from 1 March. Not speaking about payment, we're speaking about control. What do we mean by control? They can obtain benefits, economic benefits, for using this coffee machine, which means that revenue has to be recognized on 1 March 20.18 when the control is passed, when the customer has got physical possession of the goods, physical possession of goods, which is the coffee machine. So we are done on the 5-step. I just wanted to illustrate for you how does this 5-step model work in case you are asked to perform this in the exams. So let us now perform the journals. So we are asked in this question to do journals. So we know that we must start with journals from 20.18. So we'll have a debit, we'll have a credit, all right. Right, let's look how this is going to work. So journal number 1 is on 1 March 2018. On 1 March 2018, we are told this guy purchased this thing on credit. So it means that on 1 March, we will have trade receivable, which is a statement of financial position item. And then we'll also recognize revenue, which is in terms of profit and loss. But we do not know how much we're going to recognize because this 150,000 is on condition that it is paid on 28 February 2020. So what we do not know is how much is that amount on 1 March 2018. And this is where now we have to apply value for money principles. See how much is this amount in today's price. So we discount a future value of 28 February 2020 to a value that it should be on 1 March 2018. Now to do that, this means that we have to do a mini calculation, which we can do here at the bottom. So we have to use now our financial calculators. So one thing that we know is we know our fair value is equal to minus 150,000. So it's 150,000. We know that our N is equal to 1 March 2018, 2019, and 2020. So that makes it 2 years. Our I now is going to be equal to, now let us look what is our I. So we are told that the Lipton's incremental borrowing rate is 9%. The customer's credit risk is 15%. Now take it. This means if you can see an advertisement of a car and they tell you that in this car you are likely going to pay 2,500. The 2,500 is the company's borrowing rate that they are using. A customer's credit risk is they have to look at things like, are you paying on time? Do you pay? Are you a good paying person? Do you skip the due date before paying? They look at those areas in terms of the national consumer what scoring. So they score you in terms of your behavior, your conduct around credit. So that's what is a credit risk. So a credit risk is the customer. A borrowing rate is the entities. So it's like you are told that a bank will always borrow you a loan, whether it's a house for a bond or whether it's for a car or a cash loan. They tell you that the borrowing rate, which means that they are using the rate of borrowing money from getting money from South African Reserve Bank, and then they're also using their own percentage added to that, and then that rate is what your bond is calculated from as a minimum. So they look at your credit risk, your behavior. So the customer's credit risk in this case is 15%. So this is what we are going to use IS 15%. So what are we looking for here? So we know that payment is going to be equal to 0 because there's nothing to calculate on payment. So what we therefore have to compute, it is the present value, which should be equal to whatever. Now, I want us to take our financial calculators. I'm using EL Sharp 738. Those that are using HP, I think previously there was someone who shared how you should configure your calculator so that it shows that you are working on an interest per annum. So it's shift over interest, I think something like that, shift what plus 1. So we have to say first, second function, clear anything that was in the memory of the financial calculator. Then we've got 150,000. You make as a minus, which means future outflow. It's FV, which means future value. Our N is 2 years, 2N. Our interest is 15 interest. Payment is 0. And then we compute present value. So my present value is 1113,421.55. Now you will always be told in an exam that you must always round off to the nearest value, which means that your nearest value in this case is 113,422. 113,422. That's your nearest value. So you've got revenue that you can be able to discount into 1 March 2018, which is 113, and your trade receivable is 113,422. So then at the end of the year, which is now on 28 20.19 when the first year ends. But before the first year ends, here we were recognizing date that the control is transferred. So that is our narration. So on 28 February 2019, remember, this customer is not going to pay us 113,423. They are going to pay us how much? 150,000 on 28 February 2020. Meaning that on 28 February, we need to increase our trade receivable with what? With something that is called finance income. So this is a profit or loss income. So how do we get to here? So to get to here, it's either on a financial calculator, you have to say amortization, and in your amortization, you get the value by just moving everything forward as 17,013, or you use another principle which I'm going to just show you now. This is why now you have to be good in your financial calculator. Another way I should be 113,422 multiplied by your interest of 15%. So another way is to say 113,422 multiplied by 15% gives you that interest. Another way it is saying amortization in your calculator. You just say amortization, then you move everything forward. So you say you press the bottom button in terms of your financial calculator. And this is recognizing finance income accrued on outstanding amount right, and then we move on, and then we go to 20 February 2020. It is the last year. In the last year, we'll also have trade receivable. We'll also have finance income. Now, in this case, what we have to do now is to say 113,422 plus 17,013 multiply by 15%. Or in your financial calculators, you say amortization. Then you say period 2. And then you get your amount of 19,000. So period 2, amortization period 2, enter. 2, enter. So in your amortization calculator, EL sharp, you need to say amortization. You are looking for period 2 is equal to period 2. So period 1 becomes 2, period 2 becomes 2, and your interest rate therefore becomes period 1, 2, enter, period 2, 2, enter, and then your interest rate there becomes 19,565, or alternatively, you use the manual method of saying 113,422 plus 17,013 multiplied by 15%, which gives you 19,565. Then, because this is the last year that we are dealing with, if you are adding everything up, you are going to get now to where we are receiving now money into our bank account, which is now going to be 113,422 plus 17,013 plus 19,565. If you add all those together, 113,422 plus 17,013 plus 19,565, you should get 113. You should get 150,000. And then your credit becomes now trade receivables, because now this is what this guy has paid over the period, which is 150,000. This is recognition of quantity. Remember, the settlement date is 28 February. So let us read this again. The settlement date is what? 28 February. This is when amount is going to be paid at. So which means that if you're following these transactions, on the 1st of March, we're recognizing trade receivable as of the date that the machine is given over. And we also recognize revenue on point when the machine is given over. The finance income becomes your other income. Your finance income becomes your other income in terms of statement of profit or loss. Then it's recognizing finance income accrued on outstanding amount. So these are the journal entries that we follow. This is now in determining the transaction price. Performance obligation, we can able to see when the performance obligation is satisfied. So step number 4, allocating transaction price to performance obligation. It is doing these calculations. Right. Let us now look at example 2. Example 2, Bugatti Ltd enters into an agreement with Mike for the sale of the latest SUV 200 CRDI along with a 4-year service plan for a total of 900,000. So for the 5-step model, I want to only do step 2. Okay, we might as well as do all these steps. Enters into an agreement with Mike for the sale of the latest SUV CRDI along with the 4-year service plan for a total of 900,000. Any client may also acquire the SUV Bugatti without a service plan from Bugatti Ltd at a stand-alone selling price of 860,000. Bugatti Ltd regularly sells a 4-year service plan to the customers at a stand-alone price of 60,000. The sale took place on 1 March 2018. The entity has a February year-end. Bugatti Ltd maintained a gross profit of 25%, service intervals at the end of each financial year. So these 2 last statements are very important. I will explain to you how important they are as we are doing journal entries. Very important. It means that now we have to recognize your cost of sales, and then you have to recognize your inventory. That's what it simply means. Then on top of that, you are dealing with service intervals that are happening each year, which means that we have got to do about 4 years so that you can understand how this works in terms of a 4-year service plan. Required, discuss. After discussion, journalize the above transactions in the book of Bugatti Ltd for the years ending February 2019 and 2020. So let us look at this allocation. So let us discuss this. So what are we discussing here? We are discussing one, what we call a performance obligation. So the question is, you've got 2 goods and services. You've got a car, SUV, and you've got a 4-year service plan. Now, if you are looking at performance, a promised goods or service, step 2, we are looking at whether the goods or services are distinct. So when we are saying distinct, what we are saying is Mike, the customer, can benefit from the good or service either on its own or together with other resources that are readily available. And Bugatti's promise to transfer motor and the service plan to Mike is separately identifiable from other promises in the contract. So 1, the motor and service plan is regularly sold separately by Bugatti. So this is what you have been told. That Bugatti has got a standalone selling price for a car, and Bugatti has got also a standalone selling price for a service plan. Mike can benefit from the car and the service plan on its own, or with other resources that are readily available to him. So, which means, in this case now, this means the motor vehicle and service plan are separately identifiable. So a car, which is the SUV, and service plan, both of these they are separately identifiable. So what does separately identifiable means? This simply means getting a car, a promise for a car, and a promise for a service plan. So, which means they can be sold on each other, the car and the service plan. So, the delivery of the car will happen on its date. So, revenue recognition for a car will be on delivery day. This is for a car. Whereas the service plan will be recognized over time, which means that on service intervals that you have been provided. So this simply means the delivery of the car and the service plan are both distinct, are two separate performance obligations within the contract with Mike. So, which means two performance obligations therefore exist. So this means two performance obligation exist. So when two performance obligation exist, now this simply means in recognizing revenue, we need to identify a selling price from the 1100. So we need to allocate transaction price over performance obligation. So to do that, now we need to do this calculation, which is gonna show a motor vehicle and a service plan. So the motor vehicle is the SUV. Then you can do its description. You are told that its normal standalone price and you have to calculate a ratio. So its normal standalone price of a car, it's 860,000, and of a service plan, it's 60,000. And the total that they make is 920,000. But But myself and yourself know that Bugatti Ltd and Mike, in their contract, everything was sold together for 900,000. This is what we know, is that this was sold for 900,000. That's what we know. But the standalone prices are 920, which means we now need to find a ratio. A ratio that makes up how much it is that the SUV and the ratio for the service plan in terms of the total of both of them together, which means that the transaction price is therefore going to be 900,000 multiplied by their proportion. The proportion that they take in terms of their calculation that we are doing here. So we have made a ratio of how much in terms of the total price is the motor vehicle percentage and the percentage for the service plan. And this is how much we are getting to 900,000. This is how we got to 900,000. Now that we are able to calculate the transaction amount, now we should do revenue recognition for these two, for motor vehicle and for service plan when the reference obligation is satisfied. Now on 1 March 20.18, now we're doing tenors because we have the transaction price, and then here we've got debit, got credit, got the R, we've got the R. So on 1 March 2018, when the sale took place, so the sale took place on 1 March 2018. On 1 March 2018, we have to recognize into our bank account, we have to recognize 900,000. I'll explain it. 900,000 is the sale amount. So the customer on that date would have paid 900,000. And on the same day, we recognize revenue. But the revenue that we are recognizing, profit or loss, is for the vehicle, because that one is recognized on the delivery date. It's recognized on the delivery date. Service plan is recognized over time in terms of service intervals. So we've got the value. We've got the value here. So let me just try. Sorry, what I'm trying to do is to I'm trying to rounding off so that this is not difficult for us. So I'm just trying to do a rounding off to make things easy. So which means that now our revenue now is going to be 841.04. And then we have something that now we are going to call a contract liability. And this is now going to be SF, statement of financial position item. This is now the item that is new in your hands, contract liability, or you can also call it income received in advance, because remember, it's money that we've received in advance, but not yet going to be applying it. So we can also call it income received in advance, but the best word that I would advise is contract liability. It makes things easy for you. And then it is the difference, which is 58,996. Right. Then you get 900,000, 900,000. And here we're recognizing sale of vehicle on date of sale. Including service plan liability. So we're recognizing sale, or you can see here revenue of vehicle on the date of sale, including service liability. Now let us look now at what else now on this date we have to recognize. Let us look at the question. Bugatti Ltd maintains a gross profit percentage of 25%. So you are told, so which means if they are maintaining 25%, you must calculate cost of sales, profit or loss, and then you must also reduce your inventory in your statement of financial position. So we know that if the gross profit is 25%, it means then the cost of sales is 75%, which means that it's 900,000 multiplied by 25%. 100,000 multiplied by 25%. Sorry, 75%. 75%. Sorry, 75%. 25%. Which means that your inventory at cost is 675,000, and therefore this is accounting for inventory on selling of motor vehicle, because this motor vehicle now will not be in our books. It will not be an asset, but it will be inventory. So how did we get to this 75%? I'm just going to illustrate it here. So we've got the revenue, 900,000. We've got cost of sales. Then we've got gross profit. So if we say gross profit is 25%, they're actually meaning that gross profit would have been 900 multiplied by 25%, which is 225. And cost of sales would have been 900,000 minus 225, which is 675. So that's what they mean. So I just want you to understand this language of maintaining a gross profit of 25%. How does it come in? So this is just me illustrating to you how does it work here. Right. So we are done with 1 March 2018. We now move to end of the year. End of the year will be 28 February 2019. So in 28 February 2019, remember, revenue, we are done. We've recognized whole of the value of the car. Now we are moving on to the contract liability. Now, contract liability, is going to be a 4-year service plan, which means that if it's a 4-year service plan, on each year you've got a service interval. So we're going to have a contract liability if you are going to debit, and then you're going to recognize revenue, profit or loss for service plan. And the calculation is simple. It's 58,696 divided by 4. It's 58,696 divided by 4, which is 14,674. Then your recognizing revenue when performance obligation is satisfied. So that is what happens in the current year. So we are looking at what happens now in your books. Remember the service parts that you are going to use. Those who have the car will remember this. On the service plan, you will have expenses that you are going to incur as a company, and you are going to pay them from your bank. How are you making up this? It is your cost of sales, meaning that it's the parts that you are using for the service plan, which is going to be 14,674 multiplied by 75%. So it's 14,674 multiplied by 75%, which is 14,674. I will have to we'll have just to round off 1106. That is our expenses. SF Bank is statement of financial position. Then we move on, we go to 28 February 2020. So in the following year, the same thing would happen. You will have to recognize the liability, and then you will have to also recognize the service plan as well. So that's basically how it works, because here the service plan, it's accounting for to satisfy performance obligation. It's all the material that you want in order to satisfy the obligation. So please, when you are reading this part, it's very important for me that you observe it and you understand it fully. So I'm just going to continue, and we're just going to look at the previous exams. We might not, in the interest of time, we might not get to writing the solution in full, but we will, of course, look at the possible answers that you might have given, so that you are also comfortable in future with everything that we have covered, and also in helping you understand this topic. So let us look we're just going to look for the question paper for October, November 2016. right, I thought I was going to get it very quickly. There we have it. So this is your question paper for October, November 2016. Question number 3 was revenue. So let us go straight to question 3. You were asked to do journal entries for this transaction and it was 20 marks. And here on question 3, on 1 March 2016, Hot sold furniture for 25% to Smoke Ltd on credit on condition that the full amount must be paid 36 months later. Hot Ltd has an incremental borrowing rate of 7% per annum. It was determined that the discount rate that reflects Smoke's credit risk is 9% per annum. So assume the financing component is significant, credit loss are not expected at any stage. So journal entries. So here, one of the things that do not seem unclear, that can confuse you as a student is you are not told for what period of these journal entries. But these journal entries must be for the 36 months of contract, which means that this is equal to 3 years. This is that, which means these journal entries, you have to make them for how many years? 3 years. The first year, you are going to do exactly what we did here. You're going to first recognize trade receivable. You're going to use credit risk as interest rate, future value, and then you're going to convert these months into 3 years, which is N is going to be 3. So if you are using a financial calculator, future value is going to be 25,000. Interest rate is going to be equal to 9%, and your payment is going to be equal to 0, and then your N is going to be equal to 36 divided by 12, which is equal to 3 years, because remember you're going to want to deal with 3 years. Then you're going to compute for present value. Let me see if I'm computing for present value. What would be my present value? Future value 25,000. Interest 9%. N is 3 years. Compute present value. You should be able to get 19,305. And then each year you have to recognize trade receivable and income, trade receivable and income. And then your last journal entry would be to debit bank 25,000. Year 3. This is what you will do on year 3. Debit bank 25,000, and then you will also credit trade receivable 25,000. So can you see on year 1 you're recognizing this 13,000 as your trade receivable? So you're saying debit trade receivable trade receivable 19,305, and then you're saying credit your revenue, which is going to be 19,305. This is what happens on 1 March 2016. And then on on 31st, no, in fact it's 28th Feb 2017, you are therefore going to say debit trade receivable then you need to say 19,305 multiplied by 9%. It's going to be 1738. And then you're going to credit finance income with the same thing, 1738. So in year 2, year 3, you do the same journal entry. For year 2, for year 3, exactly like we have done in this case. And up until you get to trade receivable and bank account, which is settling the amount of 25,000. So this is what happened on question 3. So it's something that I think you guys can be able to do. I will I just want to look at other this. I'm going to upload it just afterwards now. So I also want to look at what is it that we had previously in our exams, because remember this is the last class. So I just want to make a browse possibly of the previous year's paper. Visual study material. So we'll just take an example of one question paper. We're not going to try and do all of them. Let's pick any one. Let's pick the previous year's one. 1 October, November. I've never done these question papers, but I just want to illustrate a principle to you. Sorry, I'm opening a wrong module. Let's open FAC26. Let's look at previous year's paper. So in previous year's paper, there we have it. We were tested on revenue. It was page 50. It was question number 4, and investment property. So can you see? It's exactly what we have done. It was there in 2016. It was there last year. Exactly what we have done. Assume a financing component, journal entry is 15 marks. You're doing it for how many years? For 2 years. Just from 1st January 2017 to 31st December 2018. That was the revenue part that was covered on question 4. Investment property, you had to do journal entries, extract an asset section. So question 2, there was a lease on it. And then there was, let me see if there was any financial instruments. There is a long-term loan. Additional information number 3 and number 6. Long-term entered into. There is the long-term entered into 8 equal installment. Interest calculated 15%. So you are told the current portion and the long-term portion, and you are asked to do the notes. Profit before tax note, as well as the note to director's remuneration. And then the rest was multiple choice. Let us look at May, June 2019. May, June 2019. They did not show exactly something called revenue, but it was covered within these questions. So this is a lease. This is a lease. This is investment. This is inventory. Here again, credit sales took place with a total consideration not yet recorded. Sale consisted of a significant financing component, must be paid on 28 February. So you have to discount the 350 into what is the value on 28 February 2019 using the present value, discounting it with an interest rate of 13.5 and becomes 1. Can you guys see that it was also, revenue was also tested? So this information is integrated. Let's see, October, November 2018. You've got leases on question 3. Revenue is also included. Let us look if we can find revenue. We've got leases. Right, question 3. Question 3 is leases. So you do here leases in terms of IFRS 16. I wanted to look between question 2 and question 1 if we had revenue. So revenue might have been covered in terms of question 1, in terms of your multiple choice. But what I'm trying to say is, if you are looking at the presentations that have been shared for all these subjects, I just want to go to the presentations that have been shared. Just looking at the last part, it says, in terms of the examination tips, read the required first, draft the format of the required statement, and to be able to do any work, you must practice lots of statements and lots of questions, and you must be able to apply your time management. What does time management mean? 1 mark is 1.5 minutes. That's what 1 mark is. You must be able to understand the disclosure requirements. So that is what you need to know. So I am hoping that everyone is understanding where we are and everyone is on board in understanding revenue, in understanding financial instruments. We did revenue 5-step. We did 5-step model revenue. After doing 5-step model revenue, we did the journal entries and we did everything else. So I hope everyone is honestly understanding how everything I've explained. So I'm just going through the chart to see. So it's just Dana who will private message Ruan to understand HP. So that is it for today, guys, ladies and gents. We have covered revenue. We have covered financial instruments. All that is now expected is on your side to do lots of practicing. Accounting is about practicing and understanding the theory. So that's what I tried to do today. I tried to cover a lot of theory. I've tried to cover a lot of practicing, but in practicing, understand they can give you the same question, but ask you something else. Specifically on revenue, understand the wording performance obligation, promised contract, distinct series of goods and services, depending on each other or not. And the example of service plan and the car is one nice example. Other examples is of your cell phone contract, where your cell phone, you can recognize revenue immediately when you leave with your cell phone. But the airtimes and the minutes that you get, they are recognized over time, like exactly like service plan. So there is a timing, terms and conditions of recognizing the minutes of the contract and recognizing the SMSs and all that, which are coupled in the cell phone contract. So please understand these terminologies: performance obligation, identifying a contract, determining transaction price, allocating transaction price, recognizing revenue when performance obligation is satisfied. 5-step revenue model, very important. So you can now be able to go back and do integrated questions in terms of the presentation of financial statements. Example 5, you can be able to do exam questions. You can be able also to perform some of 102 tutorial letter 102 questions, which are exam type questions that have got solutions. Please work under exam conditions. Do not be tempted by any means to try and do the OYA method of looking at the solution whilst you are doing the workings. So thanks a lot for attending. And I do note that you guys are going through hard time in terms of preparing for your exams, which are going to be non-venue based. Please keep in contact with the lecturers. If you have any anxiety, if you must have planning in terms of parenting, in terms of planning the study leave, please plan carefully. Now your home becomes your place to study and to write exams. So please do try in the exam time to try and write exam under exam conditions in your own place, because under level 4 lockdown, you can still not write anywhere else except in your home. So please make sufficient planning to have enough data in case you will need to access my UNISA. Of course, to access it, you just need minimum data. Once you are on my UNISA, it becomes free. But please plan for the best, plan for the worst, be ready, no matter what's the weather, no matter the conditions. And as I say, practice the format of the statements, understand theory, do many questions. If you have a prescribed textbook, work through the examples, work through the comprehensive examples, try to integrate everything that we have done so far. And I hope the recordings that we have made previously and today's class is meaningful. It will come to help you a lot. Look out for emails from your lecturers, e-tutors. Get that support that you need. Look at the nice summaries that they have for you in Word, in PDF, that are sent by lecturers, as well as videos that you can access on YouTube about each study standard for you to have a better understanding. With those words, everyone, keep well. All the best for your exam. Know that the exam is not meant to fail you. It's just meant to test your knowledge and your application. So please make your best in terms of preparing. Don't cheat yourself. Work under exam conditions. Learn where you go wrong. Study the principle again. Attempt it again. You will get it right. I'm from studying through UNISA, distance learning. I know the pain of studying in the distance learning environment, but we have to make sacrifices and we have to learn as much as we can. Please remain motivated. These exams, they need you on your A game. Be motivated. Do not let anyone bring any negativity to you. Thank you very much. Keep well and all the best. Thank you. For those who did not capture the student numbers, please make sure that you capture your student number. And also please go and look for the feedback form on the files. Evaluate the support. And again, I reiterate, this is the last class that we had. And now it's between you, the lecturers, and your e-tutors. Thank you very much.